U.S. nat gas futures dropped around 3% early Friday, hitting a one-week low. The decline was driven by a rise in daily production and updated forecasts indicating milder than expected weather for late November. That mild late November weather should reduce heating demand and allow utilities to continue injecting more gas into storage for another week. Capping price losses was a recent increase in the amount of gas flowing to U.S. liquefied natural gas export plants to a 10-month high and an increase in gas prices in Europe to an 11-month high. For the week, the front-month gas futures were up about 6%, putting it on track to rise for a fourth week in a row for the first time since September. During those 4 weeks, the contract has gained about 20%. Analysts said utilities added more gas to storage than usual during the mild week ended November 15. If correct, that would be the first time inventories rose by more than usual for 5 weeks in a row since October 2022. There was currently about 7% more gas in storage than normal for this time of year. Despite this, prices continue to climb, offering an encouraging signal for bullish traders as winter approaches, especially with forecasts pointing to a high probability of a much colder season this year. Prior to the past month or so, injections had been smaller than usual for 14 consecutive weeks. This was due to many producers reducing drilling activities earlier this year after average spot monthly prices at the U.S. Henry Hub benchmark in Louisiana fell to a 32-year low in March. Prices have remained relatively soft since then. Average gas output in the U.S. eased to 100.3 billion cubic feet per day so far in November, down from 101.3 billion in October. Meteorologists projected weather in the U.S. will remain mostly warmer than normal through November 30 except for some near-normal days from November 21 to 24. But with seasonally colder weather coming, analysts forecast average gas demand in the U.S., including exports, would rise from 108.1 billion cubic feet per day this week to 109.1 billion next week and 117.7 in 2 weeks. The amount of gas flowing to the 7 big operating U.S. LNG export plants edged up to an average of 13.3 billion cubic feet per day so far in November, up from 13.1 billion in October. On a daily basis, LNG feed gas was on track to rise to a 10-month high of 14.4 billion cubic feet per day on Friday, with flows to a few plants hitting multi-week highs in recent days. The U.S. became the world's largest LNG supplier in 2023, surpassing recent leaders Australia and Qatar. This shift was driven by significantly higher global prices, which fueled demand for increased exports, partly due to supply disruptions and sanctions related to Russia's special military operation in Ukraine in February 2022. Meanwhile, European natural gas futures have been trading around €45 per megawatt-hour or around $14 per metric million British thermal units, close to their highest level since November 2023, as colder weather increases demand. Forecasts show temperatures staying in the low single digits until late December. The potential end of the Russia-Ukraine gas transit deal could have significant ripple effects on both global and U.S. gas prices. Disruptions in this critical supply route may tighten European markets, driving up demand for U.S. LNG exports. This shift could create upward pressure on domestic prices, further highlighting the interconnected nature of global energy markets. Natural gas dropped to a 5-day low of $2.69 on Friday but rebounded as increased demand triggered an intraday bullish reversal. By the close, prices ended in the upper third of the day's trading range, forming a bullish hammer candlestick pattern. Moreover, a shift to colder weather patterns later in November, combined with steady LNG export demand, could create a foundation for a bullish reversal if heating demand accelerates. Friday's price action indicates a successful retest of support near the $2.70 level, building on the initial test in early November. This development could set the stage for another breakout attempt above the $3 mark, following Wednesday's failed effort. Whether $3 continues to act as a resistance level or gives way to a sustained bullish breakout remains uncertain. A daily close above $3 would confirm the breakout, positioning natural gas to target higher levels. Please like, subscribe, and comment to support the channel. See you in the next one.